record this before I forget. All right, so what's going on, everybody? Rasool Sierri back at you with another video. Today I'm here with a whole bunch of my friends and some new friends to meet and everybody, and I'm going to be going over my latest acquisition, which is going to be the Texas 3-pack, which I think I have pulled up by now. But I'm going to be going over um, all the intricacies of this pitch deck. And then if you have any questions, if you're new, if you're old, if you're seasoned, whatever questions that you guys have about multifamily investing, because I know there's a couple of people on here who are absolutely brand new to multifamily investing, and that's okay, right? That's why I'm here. I want to be able to help educate you guys, help you understand how the business plan works, right? So one of the things that you'll notice in this pitch deck is that it does not include an explanation of the mechanics of multifamily investing. So that's something that you got to be very, very familiar with. So case in point, I'm gonna give you guys a really quick crash course from the beginning, right? So by show of hands, I see plenty of people who are on camera. How many people are familiar with residential real estate investing? Most people. And then multifamily investing, you guys understand the difference between commercial and residential? Yes? I see a couple nods, everybody has their hand. Okay, good. So with that being said, for you new guys, or you guys who are not on the camera that I can't really check right now, the real power of multifamily over residential, right, is that you have the ability to deploy a lot more capital at scale than you could on the residential side, right? Because let's just say you buy a house, the only options you really have on a single family home are, you can wholesale it, you can do a buy and hold, you can do a fix and flip, and you're kind of limited in returns on these types of deals to, on a very good wholesale deal, you probably make, $20,000, $30,000. On a very good fix and flip, you're talking about maybe $50,000, right? But when you start getting into these large multifamily properties, now you guys look around the room, all of us want to get together. We can pool our capital. Individually, yeah, we might have to go and buy single family homes, duplexes, quads, something like that, right? But collectively, we can all deploy our capital into a single large multifamily building, and then we can do basically a large fix and flip on this ginormous asset that's worth 10, 50, in this case $111 million, right? And by and large, by being capital partners, you are absolutely passive in that whole entire endeavor, right? And then the same principle applies as far as doing your fix and flip, but on the commercial side, right? You have the banks are looking at these properties not necessarily as comps of everything else that's in the area, like on the residential side. The banks look at it like it's a business, and businesses are valued by how much income that they generate. And by strategically identifying properties that are operating well below the market value, getting it at a good basis or cost per door, right? And then being able to deploy capital into that property for capital expenditures. You want to do rehab, renovations, and then for every dollar that you can increase your net operating income, which is your rents minus your expenses, right? For $1 increase, you're looking at a $17 to a $20 increase in the overall value of that property. So how does that translate in simple terms? Let's just say you have a 100-unit property. If you can raise those rents by $50, right, on average throughout the whole entire property, you're looking at a $5,000 per month increase in income. Not a big deal. Over the course of a year, it's like $60,000. Big whoop. But that $60,000 increase in the bank's eyes on a normal multifamily property, which is going to be operating around a 5 or 5.5, 6 cap or something like that, you're looking at an increased valuation of $1 million, right? $1 million just because you were able to strategically, right, and tactically, right? You have to, you can't do this arbitrarily, because if that was the case, you can just go buy anything and pump some money into it and get a return on the back end, right? Because of what happened last year with interest rates and the economy and everything like that, it's been extremely difficult to try to be able to make that spread because properties are trading still around a 5.5 cap, but interest rates are like 6, 7. If you want to go a bridge debt, you're looking at 8, 9, 10%, right? Your delta, you're so upside down in cash flow with the way interest rates are, which is why I'm super excited about this opportunity I'm about to share with you guys right now, because we are actually assuming their in-place debt of 3.8%. And it still has 7 years of interest-only payments on it, right? So before I go ahead and jump into this, I'm going to share my screen. Does anybody have any questions? You're like, shut up, just talk about the deal. I didn't come here for you. All right. Let's see. And let me pull up my schmancy notes over here. Okay. Let me know if you guys, and I will have my chat open as well. So if you guys want to type anything, let me know. Can everybody see my screen?
Yes.
See thumbs up. Here's some yeses. Awesome. All right. So welcome. I don't even know how to do it. This is not even a presentation. This is straight up PDF. I'm just gonna read this to you guys and tell you a little bit some of the behind the scenes stuff about why we love this property. So if you guys don't know, I am the director of acquisitions for Disrupt Equity Partners, a Houston-based private equity firm. It's owned by Ferris Musa and Ben Suttles, and we are partnered on this deal with Open Door Capital, which is another private equity firm owned and operated by Brandon Turner, Brian Murray, and Ryan Murdoch. If you guys are familiar with Bigger Pockets, Brandon Turner was like the face, the guy with the big beard, really tall, lanky, skinny guy. And he did a lot of real estate education. And he's partnered with us on the last 7 deals that we've done, including a Florida portfolio, a Texas 2-pack, and various other deals that I'm going to actually talk about here because they're located right down the street from where some of these other acquisitions are, right? So the very first thing, this is just informational purposes only. Always consult your legal counsel as well as your financial advisor, right? Always do those things. Don't take what I or anybody else says online. Just because you heard it on the internet does not make it true. Do your due diligence, dig into the numbers. I can't stress that enough. And I always try to do my best to dig deep into like the underwriting. And if you guys know me, I'm a math nerd. I just love to look at everything about these types of deals and make sure that people have 100% transparency in doing it. I have a nickname. They call me Deal Killer because I go in so conservative to a lot of deals, and I always expect the worst so that worst case scenario we can still make a solid return for our investors. But if some of those things don't happen, then you guys will see later on in this presentation what happens when you are very conservative going in on the back end of these deals, right? So real quick, the reason why we love this Texas 3-pack, I said this before the presentation, we got assumable low leverage fixed rate debt. Right now, the reason why, if you guys were on this call before I started the presentation, I asked around for some of the guys who are actually experienced and seasoned in multifamily investing, how their experiences in today's current market, right? And unanimously across the board, and even for us too, it's been extremely difficult trying to identify and find deals because right now the climate of the economy is extremely shaky. Interest rates have risen 8 times over 2022, and then now in 2023 they're still looking at more rate hikes, which is absolutely insane. They're just squeezing the life out of the economy, making it extremely difficult for people to be able to do deals. So when you have the opportunity, and if you have been looking, you'll see there's a lot more deals that have been coming on the market that are selling their assumable low leverage debt as a plus for that deal, but it also comes with a really high price most of the time. In this case, because we were able to negotiate through our established broker relations. I don't know if you guys saw the report that I did from Inc. 5000 for 2022, where Disrupt Equity was awarded the top 3 real estate companies in Texas, which is absolutely phenomenal, right? So I align myself with some guys who are super heavy hitters. The other plus side about this type of debt in this market, 7 years of interest only payments, so we don't even have to pay the principal throughout the entire time that we're planning on holding this property. And we're going in with super low leverage, right? We're not just doing the minimum 20 or 25% down payment. We're coming in with 39% down to make sure that even in the future, with interest rates continuing to rise, right? If cap rates trend upward as well and values come down, we're not going to be in any danger of getting foreclosed on, right? Because we're going to be cash flowing for one, and number two, we're still going to be positive because we're not borrowing too much money, right? So we also got this at a $24 million discount. The seller of this portfolio was trying to move this thing last year when they realized all the interest rate hikes were happening, and they got their BOV, their broker opinion of value on their property at $135 million. And they were just trying to sell it and move it. But most people were like, pencils down, we're not buying anything. So last year started this whole kind of like drought of buying in the multifamily industry. And so these guys could not move, especially an asset of this size. People were too afraid of taking the risk. Towards the end of the year, when things kind of started like leveling off a little bit, and we didn't hear about any interest rate hikes for the first quarter of 2023, that's when people started coming back up, resurfacing. And we actually had relationships with the broker that were well established. We've done deals with them in the past, and they knew that we were still interested in buying because we saw the writing on the wall about the population and workforce growth in Texas. And just through having some awesome relationships and being able to negotiate that, we were able to get into this deal at 2023 pricing with 2021 interest rates. Absolutely phenomenal combination, right? And we've got low leverage on that as well. And so these properties are actually close to other assets that we own. We have a map that I'll show you guys where our other deals that we purchase and that we own and operate are. And so it's just going to be, throw it in the bag. It's going to follow our same business plan. So having properties that are already established, we know what we can get for rents and what the market is doing locally in both these areas in Austin and in Houston. And so it's just a no-brainer with the way everything is just aligning. Now, one of the things that if you're a multifamily investor, and it's pretty much always stressed to you, is, hey, this is a numbers game, right? And by somebody write in the chat, let me know, how many deals do you have to underwrite to find one that pencils well? Somebody let me know. 100 plus, says Liz. Jonathan says 150. Victor says 100. That is extremely accurate. It takes about 100 deals before you find one. It used to take 100 deals before you found one. And that's when things were pretty decent, right? Tony says 1,000. It feels like 1,000, right? In our case, because of our CRM that we use for deal tracking, and we basically have a pipeline of deals that come through, in order for us to get this deal, right, we had to go through 700 properties of underwriting, and like it blew my mind, because from where brokers are saying pricing was and where we were to be able to get the returns that we need for our investors on a conservative basis, sometimes we were off as much as 35% of that whisper price. And we're like, bro, something is wrong. I don't know if the model is broken or what, but the math ain't mathing on what these guys are saying. And sure enough, in the beginning of the year, right, we thought we were going crazy. I mean, I thought I was doing something wrong personally, but I was like, hey, math is math. I just got to trust the numbers. Pretty soon, my phone started ringing, and I got brokers saying, Rasool, my friend, it's been such a long time. How are you? Are you guys still purchasing properties? As a matter of fact, yes, I am. It's like, well, I saw that you signed the confidentiality agreement for this deal, and so on with the conversation. When brokers are starting to reach out to us, that's how you know it's getting bad for these guys, right? And we had to go through 700 plus deals to find this one. So technically it's a 3-pack. And if you divide that up, you're looking at 230 some change, right? So it's not that bad to say, oh yeah, we underwrote 700 deals to find this one. Mathematically, it's still about 200. So I would say estimated like it's probably about twice as hard to find a deal today as it was back in 2021, 2020, right? And don't even get me started on going before that, because you could have bought anything and been profitable in that time, in that day and age, right? Which is why it's so important right now to be able to understand how these deals work and why you have a solid business plan behind it, right? So real quick, I'll go over the team. These are my homies, Ferris Musa, Ben Suttles, the owners and operators of Disrupt Equity, the principal partners. They are going to be the boots on the ground because we manage in Houston. Our headquarters in Houston is actually about 10 minutes from one property and 15 minutes from the other one in Houston. And the one in Austin is right down the street within 5 minutes of both our other assets that we bought last year, right? So talking about having these properties located in the best place, in the highest growing markets in Texas, right, that we already have a presence in and operational experience. I mean, this is kind of like a no-brainer. Brandon Turner, Open Door Capital, Brian Murray, they are the ones, funny story, they actually historically were buying mobile home parks primarily, right? Then they had a meeting with Ben and Ferris. I think Brian had met them first. They got to conversating, talked about multifamily syndications, and they did their first multifamily syndication with Disrupt Equity back in 2021 in July, right before I came on. It was a 532 asset, and they were like, "Man, this is amazing. We can scale up so much more in multifamily than we could doing these mobile home parks." Sure, the cash flow is a little bit less, but the upside on the back end is untouchable, especially compared to mobile home parks, which are really high cap rates, but they were really low valuations on the exits, right? You just basically keep those types of properties for cash flow. If you want to do like true value growth, wealth creation, a multifamily syndication is unbeatable as far as like risk mitigated returns, right? And so once they did that, like I said, they had done the last 8 deals with us, which is absolutely phenomenal. And they keep pressuring us like, hey, we got money to burn, right? Which is why I do these presentations, because I want to give you guys an opportunity to be able to participate in here, but don't sleep on it. Open Door Capital, I believe this offering hasn't even been out for a week yet. It's over 50% subscribed, and we're raising $57 million. These guys move like monsters. So I'm giving you guys an opportunity to get in on this deal while there's still some room. Definitely don't sleep on it, right? And we have Raj Gupta, Anna Simpson, Matt Picheni. They are some of the sponsorship team as well, signing on the debt, helping us out and operating this deal, right? So I'm gonna go an overview because I don't want to take too much of you guys' time, but I'm gonna give you some of the high-level numbers and explain exactly how this goes so that we can get to the Q&A portion at the end. You guys can ask me whatever you need to ask me about these deals, right? So why would you want to invest into a portfolio? Multifamily on its own is an already diversified asset, which is awesome. But when you buy 3 different properties, right, you have location diversification. So just in case something happens catastrophic in one location, you're still insulated from whatever's happening in these other markets, right? So you have even further diversification with your diversified asset. And then you get to mitigate single self-asset risk, and you got stabilized returns, because now just in case one property for whatever reason just does not perform, now you have other things to be able to lean on. And so it's kind of like a built-in REIT where you know exactly where all 3 assets are, how they're performing, and why they're buying it. Like an actual REIT has like thousands of properties strewn all over about. It's virtually impossible to be able to track those returns. But with something like this, when you're lasered in and focused on a particular market that has economic growth, population growth, and all these other types of things, then it makes it a lot easier to make sure that you're putting your money in a place where it's going to be extremely safe. So this is a summary of the property. We have Stone Creek in Katy, Texas, which is 208 units, built in 1999. We have Waterstone Place in Stafford, Texas, which is more of like a little bit of a suburb in Texas, built in 2001. Really large unit sizes over here. And then Treehouse in Austin. Austin has been blowing up like crazy, and we're capitalizing on the employers that are just infusing billions of dollars of infrastructure into the city of Austin, and a lot of high net worth people are leaving cities like New York and LA and moving into Austin. And so it's just really driving up the cost of living, and being able to have an affordable property, especially purchased at a low basis, is super key here in Austin, right? Your 30% offer. I'll answer that one at the end, Dave. So the executive summary. So at a high level, what we're projecting is about a 7 to 9% targeted cash on cash, and about 16 to 18% average annual return. Now that is slightly below what you would probably expect in a typical multifamily syndication, just to be fully transparent. And the reason being is because of what's happening in the economy and with the projected economic uncertainty going into the future, and the very real possibility of like a crash or a correction or something in the market, we've actually raised additional funds to be able to buffer our reserves so that this investment would make more sense. So we're kind of self-insuring on this on this portfolio, so that whatever happens in the future, plus the longevity of our loan that we have in place, we'll be able to make it through on the other side. And so that's kind of the reason why you see, instead of like 15% IR, which is a targeted 20% AAR on a 5-year hold, we're going to be holding it for a little bit longer, raising a little bit more cash just to make our investors that much more safe, right? And then the property management, we have our own in-house property management company. It's called Disrupt Management. In Houston, you can see all the locations that we have in this map on the blue on the right. The two green stars over there are where these two assets are. The Stafford one is to the south, and this other one is that western green part. My mouse kind of disappears over that blue. And then in Austin, you can see our other assets that we own and manage over there as well. Oh yeah, pretty good to know. They've got like over 50 years of property management experience on the team that is taking care of this whole entire property. So I mean, they've seen it all, and they're already operating at a very high level on our existing assets. And then we're just going to be able to bring these guys into the fold to make it that much easier, right? So Stone Creek, Katy, Texas, right? 208 units, and this one is the one that was built in 1999. It's a two-story garden style property, already stabilized, 95% occupancy. Average rent is $1,205. Now the current owners have done a decent amount of capex, but for whatever reason, they are just not really trying to be competitive with the rents in the markets, right? Which is one of the value add propositions that we saw. So even though they put some money into the property, we can go ahead and do a little bit more and just bump it to that to our standard of what we normally expect, so that we can go ahead and capture those rents. Let's see. Move people out of the way. This one is Stone Creek. Okay, so I took some notes so I can remember which ones, because having 3 properties in your head plus looking at thousands of other deals, you kind of get this sensation called deal merge, where a lot of things kind of, you're thinking about one property and it could be actually a completely separate one. But for right here, this one right here with Stone Creek, we actually have a 300 unit property development that is right around the corner from this one. So we actually believe extremely strongly in this pocket of Houston. It's got the #1 school district in this greater Houston area. And one of the things that you want to look for when you're identifying a property for multifamily investment is, where are the families going to move? When you have a husband and wife with some children, the very first thing that people consider, believe it or not, whenever they're trying to find a place to live, is where are they going to be good schools so that their children can have a good education and they can go ahead and plant roots, right? Because almost half of people in the country are renters. They're not necessarily property owners, right? And the way the economy is going, also the stuff with the rising cost of living and the increased cost of housing, it makes it very difficult for people to purchase houses, especially at these high interest rates. The qualification for their income doesn't really amount to what these houses are costing nowadays. So renting is really the only viable option that they have. And so having a really good school district is like it's kind of like a cheat code. Wherever the best schools are, that's where you should start looking to buy some properties, right? We have a lot of value add potential through continued renovations. Like I said, the ownership has already done like a good job. All these properties are in pretty decent shape, right? But we're gonna go ahead and just really push the needle and get it to that higher quality product that we're used to owning and operating, so that we can go ahead and capture those higher ends of the rents, right? Also, this market has very strong organic rent already, even though on our underwriting, we still only assume a 3% year over year rent growth, right? Once it's stabilized, which is absolutely huge. So our value add play, some of the things that we're going to do is upgrade the remaining classic units with the backsplash, undermount sinks. All this stuff is pretty par for the course for what we do on our value add. We transform the exterior by bringing horizontal cedar patios, solar screens, and applying modern updated paint color scheme that just helps make this thing stand out. And Popmore has more curb appeal, so that when people are driving by, they're like, "Oh, that's a new property. I want to go ahead and see what it is," because the vintage on this property is not that bad, right? Being a late 90s product, when historically on a value add deal, we were looking at 60s, 70s product, which definitely looks a lot dated. And no matter how much fixing up you do to those properties, just because of the architecture and the construction, you can tell the age of the properties. But on like a late 90s, early 2000s, you can actually make it look a lot more modern compared to those 70s and 60s deals, right? Has a bunch of different floor plans, 1s, 2s, and 3s over here. And there's a lot of different amenities, unit amenities, things that just make it a lot more comfortable to live in here. So these are some pictures of what the property looks like. I think exterior paint is one of those things that we do, because anytime we get like one of these, this would be great in Florida. It looks like a Florida yellow exterior color, but in Texas, that doesn't really fly. We like those off grays, blues, whites, and things like that. And you can see some of the interior colors. So it's in decent shape. Like this property is like well manicured. The pool area, the gazebo with the barbecue, all this stuff looks really nice, right? So the rent comps, you can see that the average for the market is about 1,300, and there's like a ton of upside. On the high end for the finished product, you're looking at about a $423 rent bump on the 1 bedrooms. On the 2 bedrooms, we're looking at $386. And remember my comparison in the beginning, right? $50 rent bump on 100 units is about $1 million. Right? When we start having rent bumps of this magnitude with 600 units, you guys can maybe mentally do the math, but it's like a ridiculous amount of upside that we're going to be expecting, 5 to 7 years in the future of this deal. So this is Stone Creek, where it's located right here. This is that 300 unit development that I was talking about. This is a brand new construction that Disrupt owns, and we're going to manage this one as well. It's 300 units, Class A, and it's right down the street from where Stone Creek is. So that's how much belief that we have in this pocket of Houston, right? And one of the other things that I always like to look for, I try to find Starbucks, right? Starbucks is one of the largest retailers in the country, and they do an insane amount of market research about where they want to be located. So if you guys want a really quick underwriting hack, you find the address of your property, put it into Google Maps, and then from there find directions to Starbucks, right? If it's 5 minutes or less, boom, that's a market that I want to be in. If Starbucks wants to be there, I want to be there, right? So rely on these multi-million-dollar market research guys who are doing all this work, and then they're deciding this is where I want to plop down, right? Walmarts are around. Costco is a little bit up this way, but all these big retailers are the guys that you want to be able to look for. So really excited that we found a property that's literally like 1 block over from where our development is. My mouse is so sensitive. Some of the facts about the submarket demographics: we got 727,000 people just in this part of the submarket. Renter-occupied households are only 42%, right? The average income, highly educated people, high earners, $103,000 average income within a 5-mile radius. This isn't just for like the city as a whole. This is just the submarket of where we're at. And median sale price for homes is $250,000, where some people are just priced out, right? If houses are too cheap in any particular market, then sometimes it makes more sense to just rent or buy a house than it does to rent your multifamily property, right? So I've seen that happen before. It's one of the things that I look for in underwriting is how much the homes cost. You want to make sure that they're not too cheap, right? So Waterstone Place is the one in Stafford, Texas. These are the ones with the large units that I was telling you guys about. Oh my gosh, my mouse. This one is the newest property in the portfolio, built in 2001, 168 units, 84 buildings, 96% occupancy. Very high occupancy on all these properties, which is super fantastic. It means that we're going to be able to be cash flowing from day one going into this thing. Some of the highlights about Waterstone, again, super high income, which we'll go ahead and see as well. This is a fairly a very family-friendly property. It consists of 3-bedroom, 2-bath units for all of them, right? And so again, when you have a place that has um, really high rated school districts, and you have enough room for the husband and the wife and possibly some kids and even potentially an office, something like that, it's just it creates a sense of community and some longevity for people to be able to live in for the long term, right? Because in multifamily, one of the biggest expenses that you're ever going to face is unit turnover, right? Which happens a lot more on the 1-bedroom properties, which we don't have to worry about here because these 3 bedrooms are designed for longevity for a lot of people, right? And so again, more value add opportunity across the portfolio. The owners never really pushed the rents for as much as they could. They did some kind of like mandatory upgrades that the lender required for them. But for our interests, we're going to go ahead and push the needle on that and make sure that a lot more of it is modernized. We're not going to do every single unit because part of the strategy of multifamily is you want to leave some meat on the bone. So when we do these early renovations, we purposely leave a certain number of classic units in place so that when the next buyer comes in, they have something that they can capitalize on, and it allows us a safe exit on the back end. So that's something to keep in mind as well. If you ever buy a multifamily property, you guys do not renovate every single unit. You'll have a hard time trying to convince somebody that there's opportunity for them as well. There's plenty for everybody. Always leave some meat on the bone for the next guy. All right. So our strategic value add play, once again, continue the in-place value add program, upgrade the remaining unrenovated units with granite countertops, backsplash, two-tone paint, updated fixtures. We want to make all these things look nice, new, modernized, and really attract that new tenant base. That's going to be more than happy to have a nicer, newer place and pay a little bit of a rent premium to be able to live in that location, right? So this property features detached garages, they have playgrounds, business centers, they even have storage units for people who have some extra stuff, fitness center, laundry built inside. So this is the typical floor plan for their 3-2. And then some of the unit amenities, patios, fireplace, wood style flooring, alarm systems, granite countertops, right? So these are nice, like luxurious feeling places. This is a place that people would consider their home, right? Property overview, this is what it looks like right now. Again, par for the course with the well manicured lawn, and the exterior of this property is done pretty well, and the playground looks nice and new and well upkept. So the rent comps over here, you guys can see what the market premium is. The upside on this deal is just absolutely ridiculous. And it's just one of the things that we want to take advantage to. So again, one thing to note is that we don't underwrite for all of this. This is icing on the cake if we're able to hit this. But what we're really trying to do is get this our in-place rents close to the average, right? We shoot to the average or a little bit below. If we can get to the premiums, because rent growth is happening in this market and more people are moving in faster than we can bring units online, just not just us, but people in general, like new construction deals. We're in a housing shortage in this country in the markets that are experiencing rapid population growth. Now, the places where these people are leaving from might not be able to benefit from the same exact upside in the cost of living and all of that. And I say it's an upside to us as investors, right? But for the average person who's living there, there's just more competition. The demand is so high compared to what the supply is. That's what creates that income disparity. So there's more people with higher incomes coming in, and they're driving the price of living up for everybody else, which is what creates the opportunity for us as multifamily investors to capitalize on some of these upsides like this. Hopefully that makes sense for you guys. And again, Waterstone Place, one of my big things. I look for Costco's. I got my Costco right over here. Another Costco over here. And where's my Starbucks? Boom, right there. Always my Starbucks. All right. Oh, I got 2 Starbuckses, 3 Starbuckses. Man, 4. All right. I'm going Starbucks crazy right now. So I got Starbucks all around. Every single direction of this property has Starbucks locations, which is extremely beneficial, right, from a market research standpoint. So some of the other sub-market demographics that we have here now, Sugarland. right? The Stafford Siena submarket. As a frame of reference for what these markets look like, there was a point when I was considering leaving Miami and moving to Texas to be closer to Disrupt, right? Just to, proximity, power, all that other stuff, right? I wanted to be in the mix, more regular, but when I visited, it was like a really cold day one day, and I was just like, I can't do it. I did 4 winters in Kansas City, and it was like, I don't know, like 28 degrees in Houston. I was like, Miami doesn't do that, so I'm thinking I'm gonna stay here. But when I was considering moving to Texas, I was doing house tours in Sugarland, right? So I'm the type of clientele that wants to live in this market. So average income over here is slightly higher than the Katy area at 104K. Super high education levels. Consumer spending is through the roof, and the submarket is over 1 million. There's a lot of people out there, right? And it's kind of insane that in the last 3 months, the rents increased 29% just because of the influx of people over there. And like I said, that supply and demand imbalance is what causes and drives all these types of things, right? So Houston as a whole overall market, I know there's a couple people here that actually live in Houston. So you guys already know, but for those of us who are uninitiated, Waterstone is down here close to Sugarland. Stone Creek is up here in Katy. Disrupt Equity is located right here, right? This one's about 10 minutes away, and Waterstone's about 15 minutes away. And this is downtown Houston over here. But the west side of Houston is where you want to focus. If you were to look at the entire map of Houston, we primarily only buy on the west side, more north as well. We avoid the east because it's too close to the Gulf, which causes insurance costs to be through the roof, right? Whenever you're close to like large bodies of water like the Gulf, you're susceptible to hurricanes. Like that's the first place that's going to be getting the brunt of the damage from a hurricane when it comes whipping through the Gulf, right? And so we typically don't buy in Southeast Houston at all. We focus mostly on the west. And so, a couple of fun facts about Houston and how it's been growing. And one thing that I learned about Houston at a mastermind that I went to recently was that during the pandemic, right, and they shut down all travel, a lot of the flights, and all the ports around the country, the only port that was open was the port of Houston. And that's actually what was the catalyst of driving so many companies and businesses and jobs into that city, and everything just grew from there, right? And it was already a booming city, not as much as Dallas at the time, but now it's actually very comparable. So Houston is ranked number 1 and 3 for total population and job growth through 2025. All of that momentum has just been carried through, and people are just flocking to these places. And the cost of living is not that high for living in a relatively warm climate, right? For people who are moving away from up north. When people go to Florida, yes, the climate's better here, but the cost of living is like ridiculously high, especially in South Florida. You can go move to Texas where it's not as warm as I would like it, but it still works out very, very well, right? And the employment base has become increasingly diverse over time. It's the third largest concentration of Fortune 500 companies in the whole entire country. Like all of these types of things. The two things that drive multifamily valuations through the roof: populations and jobs. That's really all it comes down to, right? Because there's only so much supply of housing, and I'm going to beat that horse over the head as many times as I need to make sure you guys understand that if you're in a market, it's all about supply and demand. When there's low supply and the demand keeps increasing, there's just going to be competition for it because nobody wants to live on the street and nobody wants to commute, from 40, 50, an hour and a half away from where they work. People want to live closer to their job so they spend, better work-life balance and all that good stuff. So another thing to drive that point home about employment diversification is that, Houston's very recession resistant because look at all of these different sectors of employment. One of the worst things that you can do as a multifamily investor is buy a property in a city that has basically just one type of employer, one major employer. It could be something like maybe a university. It could be like in the case of this one city that I was looking at very early on in my multifamily career, right? I saw this 36 unit property. The price was phenomenal. I thought it underwrote really, really well. But the only problem was it was a one trick a one trick town. See, Parag, I'll answer your question later, man. Offline. Take it easy. Um, and it was an Air Force base in Sumter, South Carolina, and it was very active up until like I think after 9/11 when that war happened, and then when everything died down afterwards, they shut that base down. And when they shut that base down, all the employment left, and so most people were just like maybe local employers, mom and pop shops. There's no major retailers, no nothing like. There's no place for people to earn income, and so slowly but surely that town ended up dying. And that's one of the things that I learned. I was like, man, it doesn't seem like I can really bump rents. There's no comps that are showing that I can get higher rents or anything like that. Even though I'm buying it at a good price, there's nowhere for this property to go. There's no upward momentum. And so that's when I learned about employment diversification. So that is absolutely phenomenal to see all these other companies that are coming in, and we also have NASA down there and the whole entire space race for all these rich guys coming in and everything like that. Take it easy, Marquise. Treehouse is going to be the Austin asset. This is 297 units, built in the mid 80s, and yeah, here's the stats on that one. So 600 parking spaces, average rent's only $1,200, right? 96% occupied, and $1,200 for Austin currently in place, which is crazy low, right? The location of this property is over in like the East Riverside Austin corridor, which I'm not sure if you guys are familiar with Oracle. It has a major expansion of their business over there, and then there's also this new development Presidium project that's coming up. It's like what was that? I had Googled it before. It's one of these crazy new like energy green efficient living areas, and it's got it's a master plan community because it includes 3.5 million square feet of office space, testament to the submarket's meteoric growth. And we already operate 3 assets in here within 5 minutes from Treehouse. So we have Array and Cascade, and then also City View at Mueller, right? Mueller. So we're gonna have economies of scale by having all those assets already over there, and we're gonna be like duplicating what the design plan is for each one of these properties. So here's another thing that happens in multifamily, right? So especially compared to residential, right? I always make the comparison just so you guys understand. If you ever go to Home Depot and you just need to start buying like some materials, right? If you go buy one thing at a time, you're gonna pay full retail value for that. But then if you're able to buy in bulk, or then you start buying at wholesale, and then you have 3 properties with like nearly 1,000 units, right? And you can go ahead and start buying at scale to be able to do all these things. You're gonna reduce your expense of your capital expenditures, right? And when you have lower costs, you have higher bottom line, right? Reduce expenses, increase revenue, right? That's how you grow your NOI. There's 2 ways that you boost your NOI to be able to get those higher valuations. We're trying to go ahead and I think on this deal we're looking to create about $50-some million of additional equity into this deal for our investors, right? And then also this one is already a stabilized asset, 96% occupied, booming rent growth because Austin is like it's that city in Texas, right? Houston does very, very well. Dallas obviously does really well, but Austin is like the #1 city. So again, value add play at this property as well. It's the oldest one that we have in this 3-pack portfolio, but it happens to be in the nicest in the nicest city, right, for rent growth. So we're gonna have the ability to really capitalize on some of the upgrades there. We got different unit amenities between 1s and 2s, right? And then these are some pictures of how the property looks very clearly. We're gonna repaint that. If they don't repaint that, I'll do that myself because that green is just hideous. But the property overall is actually in very decent shape, right? Even for the vintage that it has and the level of upgrades that the seller had already done. You can see they put the backsplash, some LVP on the flooring over here, and that signage is probably going to change a little bit as well. So here's the rent comps for this area. On our 1 bedrooms, we're looking at about $300 upside, and then on our 2 bedrooms, we're looking at $693 for the market premium. But even from where we are right now on the averages, right, 1,437 going up to an average of 1812, and then on the one bedrooms we're only about 180, almost $200 off from where the average is in that market. So our real juice is going to be on that 2 bedroom side. So Treehouse Apartments is right over here next to my buddy Starbucks over here. And then you can see from where this property is located, you just go right down this street. We have the Array. This one is a 369 unit asset that we purchased last year, also with Open Door Capital. And then we also have right down the street from that one, Cascade, another property, 198 units that we purchased. So we're already operating in this submarket, right? And these two are doing phenomenally. We're just going to go ahead and have this one follow the same business plan as these guys, and everything should be tracking. We should be in really good shape for the value add proposition on this property. So Austin, as an overview, the fact that housing prices have been increasing at 29.5% year over year is absolutely insane. Like that is just like, that's probably the only time you can be like, okay, yeah, I bought a house and then, you know, it doubled in 3 years, right? This is one of those cities where that kind of stuff happens. The average rents are 51% above the national average. And then there's 184 people moving into Austin alone, not just Texas, but Austin every single day. So we're building that 300 unit property, right, in Houston. And it's going to take us like a couple of years to be able to get that thing completely finished, right? 2.5, 3 years, right? To fulfill the need for 300 people max, right? Or 300 families, I should say. In this case, that would be filled up in 2 or 3 days. This is what I mean about how the demand is growing so fast compared to how long it takes to be able to just build a property. I think some economists were projecting the housing shortage to last into 2030, 2035, somewhere around there. And that's if we're able to sustain consistent building year over year, which right now with the way the economy is working and the interest rates, it's difficult to be able to borrow money and try to put money into these types of developments. So I foresee new construction slowing down a little bit going forward if you're not able to secure like really good construction debt, right? So booming apartment fundamentals, 27% population growth from 2010 to 2022. You got 60%, 68% white collar employees, a lot of these tech jobs, nurses, medical, all those sorts of things. Median income is the highest of the three at 108,000, and then the median home sale price, absolutely nuts, at $630,000, and 43% of people have a bachelor's degree or higher. So number one most recession resistant city. I had to find my mute button for that cough. And obviously number one best market for real estate investments, right? And number seven best places to live, because you know it's still Austin. There's that many people coming in. Man, it's just hard. It's hard to compete with the rising cost of living in a city like this. So it's best to own assets and benefit from the increased valuation of that type of market dynamic, right? So now we're going to get into the nitty gritty, some of the things that you guys have been waiting for. What does it look like to invest into a deal like this? Now, number one, this is a 506C Regulation D multifamily portfolio. What that means that it's open to accredited investors only. So if you have a net worth of $1 million or more, or if you as a single person have made $200,000 a year for the last 2 years, with a reasonable expectation to continue earning $200,000 this year as well, right? Or if you're married, it's $300,000. Those are the two main ways to qualify to be an accredited investor. And there are companies out there that will verify you, or your CPA can do it as well. We're basically going to do our value add on these properties and hold it for 5 to 10 years. That is our worst case scenario. Historically, we haven't held anything beyond 3 years. In this case, because of where the market is right now and how everything is going, we just have the ability to weather that storm longer if we need to. But if we hit our numbers, when we hit our numbers, we're out. That's it, right? We strike where the iron is hot. So our projected holds 5 to 10 years conservatively. Minimum investment on this one is $100,000. Now we have 2 classes of shares in this project, right? And you can choose either or. And let me explain them really quick to you. So the Class A structure, right? They're the first in line for investments after we pay our mortgage, and they're going to get 10% on their money, right? But because they're going to be first, they don't get any upside on the back end. You invest into this Class A structure of the deal if you want solid returns that are really predictable and very safe in the capital stack. So you're gonna get 10% of your money. You invest $100,000, you're gonna get $10,000 every single year you have it. You invest $1 million, you'd be making your $100,000 every single year. That's how that property works, right? So 10% AAR, 10% average cash on cash, very straightforward. Now the Class B structure, after the Class A gets their 10%, then the Class B side gets 8% on their capital. But then after they pay their 8%, then they participate in a 70-30 split of the remainder, right? And then the Class B members, as an incentive to us, we have a 15% hurdle. So if we're able to project to 15% internal rate of return, right, it's kind of like a performance basis, then the split goes more favorably to the managers at a 50-50 split. But that's only if we're able to get that really high rate of return for you guys, right? It's kind of like an incentive for us to really perform really, really well. The Class B targeted returns, that's where we're going to get that 16 to 18% AAR, average annual return, and 7 to 9% cash on cash. As the properties become stabilized, and then we're just going to be riding that appreciation in all these high growth markets. Distributions are going to be paid monthly. We're estimating about 6 months after closing, because the first 3 months we're kind of like shoring up our numbers with the seller, because there's a lot of moving parts with cash owed to the seller, owed to the buyer, and everything gets kind of reconciled around that 3-month period. And then we just allow for some stabilization, some of the renovations to go through. And then once we start getting those new rents proven and everything is good to go, then we can go ahead and start getting those distributions. However, your preferred return is always accumulating regardless of whether we're paying it out or not, right? So that's what preferred returns mean. If you guys are not familiar with that term, definitely understand that piece. So case in point, let's just say you're a Class A holder, and you're supposed to get 10% on your money. And let's just say we only pay you invest $100,000. Take it easy, Diego. Let's just say you invest $100,000, you got 10% preferred return. You're supposed to be getting paid $10,000. If hypothetically you got paid $5,000 in that deal, we will owe you $5,000 for the next year, and we still owe you the $10,000 for year 2. So we're going to pay you $15,000 in year 2. Ideally, by that time, more renovations done, more increase to the rents, more market appreciation. So it's easier to pay it on that higher amount. So the 10% is always accruing. And same thing for the 8% on the Class B side, right? Hopefully that makes sense for you guys. The tax advantages, which is one of the biggest things for people, especially when you start creating some real wealth. The biggest thing that hurts people at the higher end is taxes, because the more money you make, the more tax that you get. And so we do cost segregation studies. They're going to allow you to benefit from estimated 25 to 45% bonus depreciation, and that is factoring the 80% bonus depreciation rate of this year, because they're starting to sunset it. And so because we take the majority of the depreciation in the first year, this is a pretty accurate estimation. So you invest $100,000, you can reasonably expect $30,000 to $45,000 and lower tax liability there. Some of the projections that we're looking at, 7.71% cash on cash, equity multiple at the end of the hold. Worst case scenario that we write it out for the entire IO period, we're looking at a little bit more than doubling your money over that whole period, which is going to get you to an average annual return of 17.13%. Now, one thing I want to say, the reason why I joined Disrupt and the reason why I like them so much is because they're extremely, extremely conservative. We are like scaredy cats when it comes to being able to look at what a deal can potentially do. And we factor in, like I said, we're only factoring in 3% rent growth after stabilization. We're not shooting for the moon on our rent growths. If it happens, great, right? We are bringing more money to the deal than we feel like we absolutely need, just to have a little bit of a buffer. So there's a lot of factors that are coming in that even from a very conservative standpoint, we're still able to hit numbers like this. And I will show you guys what our historical rates of return look like for our investors, because we always underwrite to this standard, but the historical performance, which does not indicate future performance, it's a really big note, but I mean, it's a track record that you guys should follow. The sensitivity analysis, this is just to show a bunch of different ways that we were looking at how things could go one way or the other. Let's just say economic vacancy goes a little bit higher, where we have to do a lot of concessions, or we have like higher vacancy or something like that. I mean, we're still targeting like a 13.3% on the low end. And if things go better than planned, and let's say we're stay, more occupied, let's say we're at like 95, 96%, and only conceding about 2 or 3% or something like that on the renters. I mean, we can look as high as like a 22% AR, but we're picking a good baseline right here, meeting in the middle for the sensitivity analysis, not projecting crazy rent growth, and we're still hitting that 7.7 and that 17.1 average annual return, right? And this is, again, going back into that tiered structure return. For that Class A and that Class B, for that $100,000 investment, you can split it up any way that you want. You can do 50 into one and 50 into the other. So you're getting 10% guaranteed on the one side, and it's not guaranteed. I can't say the G word because when it comes to investments, there's always risks involved. You cannot say G, but you're just in a really safe spot in that capital stack, which is why I said that G word. But I mean, at the rate of interest that we're paying on this deal and the way that it's cash flowing and the low leverage that we're going into, I mathematically I don't understand what would have to happen, right? I think like everybody would have to leave Austin and Houston all at once in order for us to be at like 40% occupancy where we couldn't barely afford to be able to pay our mortgage, right? Something like that. It's a black swan event. Absolutely crazy. Not to say it couldn't happen, knock on wood, but it's very, very unlikely, right? So for the Class A, the Class A has the 10% preferred return, and the Class B is going to have the 8% preferred return with the 70-30 split on the back end. And then we're going to own 30% of the deal as general partners, and the limited partners are going to have 70% ownership. So the $57 million is going to be comprised of the general partners contribution and then the limited partners from both classes. And then the rest of the $68 million is going to be the debt that we're assuming that's already in place, which actually happens to work very favorably in our case, because this whole debt is at 3.8% interest. It's super cheap debt, and we only own interest rates on it, right? Interest only. So a schedule of the capital improvements, our CapEx budget, our renovation schedule. This is what it looks like right here. We're putting about $6.5 million into all three properties. And you can see the breakdown of how that works over here. Overall, we're looking at just under $10,000 a door in order to get these renovations done. All right. So the sources and uses, you guys can look at this, where we're getting it from. The loan amount, $68 million. Investor equity between GPs and LPs, it's going to be the $57 million. So everything altogether, $125 million. And you can go ahead and review these fee structures. Everything is out front, bold. If you guys have already downloaded the document, you can review this at your leisure, or when I'm done here, you can ask me some questions about it. In the fund uses, we're purchasing for $111 million. You got closing costs of right around 4.5%. And then the repairs and reserves for our CapEx budget, that's how we get to that $125 million, right? So one of the things that Disrupt has that's extremely unique to them as a firm is that they have their 501c3 compliant nonprofit charity, Disrupt Gives. And in this case, 25% of our asset management fee is actually going to be passed on to Disrupt Gives, which is that nonprofit that I was just talking about. And that nonprofit, what it does is it allows rent forgiveness for certain tenants that qualify if they're going through a hardship. And it also includes financial literacy training for some of our tenants as well, just to be able to help give them a leg up in life, right? We want to be able to help out, have a strong impact on the community. And so we do that through Disrupt Gives, and that's already built into every contribution. And you guys will see that reflected on your K1s as well. So that donation is going to be made through the entity, and it can potentially, if you want to participate, give you additional write-off incentives as well, right? So the track record from what we've done, these are 7 of our last exits. We got about 50% at Woods of Decatur, 50% returns on Longfellow Apartments. These are average annual returns, by the way. Huntington Park was 100% capital return to the investors on that deal. 40% at Stone Mountain. Central Park had 36%. Marketplace at 35% year over year. And Alamo Oaks was around 20%. So that's the low end, the extreme low end of what we do. And so if you look overall, I think our track record from everything in our portfolio was about 50.6% average annual return. But from our multifamily that's in similar classes, or the B and C class of these natures, we're looking at about 35-36% average annual return. And again, very, very conservative going in, right? Because we like to under promise and then over deliver. And that's kind of what you can expect what we do. So we've managed over 10,000 units across our entire portfolio. And this is what our track record looks like, right? So we're looking between 50% average annualized returns to investors. Not projected on this deal. We never projected 50% on anything. I want to make that very clear. We're shooting for 15% internal rate of return, ideally. And this is the end result of how our underwriting looks, right? So the investment process, what does it look like? I had sent that to you guys before. If you haven't done it yet, sign up in the investor portal, right? You can review the offering, you e-sign all the documents. And then you do your funding. So the way these deals work, like I said, when these offerings come out and then Open Door Capital partners with us on them, they go extremely quickly because they have a huge investor database. People already understand multifamily investing from a very high level, and they understand the tax benefits, the cash flow, the appreciation, the forced appreciation, all the wonderful things that come with, you know, high reward and low risk investing through multifamily properties. And so there is like it's a first come, first funded, first served basis, right? So just because you sign your documents, if you haven't funded it, then you can be like one of my investors. He kind of like he waited a couple of weeks on one of my other raises, and not because he didn't have it. He was just slow. He's like, oh, I'm busy at work. I'll get to it eventually. And then by the time he'd done it, his wire went through, but the deal was already full, and so we had to issue him a refund of his funding. So I always tell investors, like, look, if it makes sense and you guys are ready to go ahead and get this done, don't waste any time, right? It's the worst feeling in the world to get to miss out on an opportunity. And of all the deals that I've done, to find something that's at a cost basis like this, I think we did $111 million, right? Purchase price for 673 units. We're looking at a cost per door of $164,000 in Houston or in Austin, let alone Austin. Austin's extremely expensive. But for Houston, $164,000 a door on the west side, close to Sugarland in Stafford, Texas. I mean, those are insane bases, right? So to be able to capitalize on something like that, you definitely don't want to waste any time from not getting involved and being involved in a deal like that, right? So once we're fully funded, we go to the closing, and then your part as a passive investor is completely done. All the work for you, the hard stuff, hitting continue and submit on your wire, that's the end of your work. You just sit back, and then all of a sudden you're gonna start getting your distributions that are gonna be occurring monthly on this project, starting right around that 6-month part. And that's also a conservative estimation because, again, we're gonna be cash flowing like crazy day one on this property because we have such low leverage and such a low interest rate on the debt, and the property is just already performing really well. So again, in order to qualify to invest into this deal, I just sent you guys the link, rasool.investnext.com. You got to be an accredited investor, right? We also accept either cash, it could be a self-directed IRA, your solo 401k, your EQRP programs, or if you have a 1031 that's currently looking to identify for a property, you can reach out to me or our investment relations team, and we can discuss what your 1031 looks like. And for you guys who are not familiar, a 1031 is when you sell a property and defer taxes by going through a 1031 intermediary, and then they will invest the money on your behalf into wherever you direct it to, and you avoid paying taxes altogether, right? So you can go ahead and participate in a deal like this, keep growing your portfolio over a number of years, and then 1031 again when you get out, right? Minimum investment is $100,000. That's in the private placement memorandum, but if you guys needed to come in at a lower basis below that, reach out to me on an individual basis, and we can have a discussion about that. And again, investors are accepted on a first funded basis, right? So if you guys are in, make sure that you commit. Click that link that's in the chat. I sent it to you guys already. Log into the investor portal, create an account there, sign all your documents, and make sure that you verify that you're accredited. There's a website that you can use. It's called Verify Investor. If you guys need that, reach out to me directly, and I'll get you that information. I think it costs like $50 or something like that, and you can be verified for 5 years, so you never have to worry about doing it again. And then once you're done with all of that, it's just a matter of sending in the wire to the operations account, and then you'll be off to the races. So some of the frequent questions that people typically ask is if they can invest using their self-directed IRA funds. 100%, as long as they allow for it. You're a SDA IRA provider. Distributions start again about full 6 months after closing. So if we close in June, then we're probably looking around January 1 for the distributions to start. So the preferred returns will start accruing right around that June time period, right? And then how much are we increasing our expenses from an underwriting standpoint in year one? Our year one expenses include a 16% average increase across all three properties, including a 14% increase in insurance expenses and about a 16% increase in repairs and maintenance, right? And our projected annual rent raises only 3% after stabilization. So in the beginning, before stabilization, we're going to be doing our value add to bump those rents up higher, seeing what we can capture from the market there. And then once we're stabilized and there's no more rent bumps, boom, we're just going to keep, hey, whatever the market's demand is. And in these markets, I am assuming it's going to be higher than the 3% average annual rent based on whatever recent inflation rates have been and the way the dollar is going. But 3% is what we underwrote to. That's probably part of the reason why we always overshoot, right? So that is it. That is the entire presentation, start to finish. If you guys hung out with me this whole entire time, I appreciate you guys. What other questions you guys have about that right now so that I can go and help hook you guys up? New or old experience, whatever you need to know, let me know. Not everybody all at once. Did it make sense? Does anybody like the deal? Did I just go and bore everybody to death for like an hour and some change, and they're like, eh?
Hey, Rasool, it's Victor.
Yo, what's up, Victor?
Hey, great information, great presentation. Thank you. I know we're talking tomorrow, but a lot of great information. One thing, I've been on several of these calls before, and one thing they don't mention, and I don't know if this is something mentioned on this call, but in discussing what what I love is that you're very conservative. The organization is very conservative. So I guess that helps lower the risk or the potential for a capital call with everything going on with the uncertainty or capital call in the near future. I would say, when I say near future, I would say probably say the next 12 months. I mean, obviously we don't know what's going to happen, right? But with
Right.
the uncertainty, and Rod, I know is big on the potential for a lot of these issues, a lot of the economic downturn potentially. So what are your thoughts on that? I mean, is that something you guys factor in, or is that, what does that look like?
That's a fantastic question. And yes, um, one of the things that we considered was if there is a drop in the market and there's a need for a capital call. And for you guys who are unaware, a capital call is, let's just say a deal's already done, we're already operating, and then we run out of money. We go to the investors and say, hey, we're about to get foreclosed on this deal. We're going to need you to increase your contribution by 10, 20%, something like that, to fill back up the coffers so that we can go ahead and run this deal some more, right? That's what a capital call is. In our case, and I did kind of touch on this earlier in the presentation, but what we're doing is that we're raising more money than we expect to need, right? And that was actually one of the calls that Ben, the owner of Disrupt, had said. He's like, "Hey, I know we normally put away $2,000 a door for reserves, but we're gonna bump that up to like $5,000 a door." I'm like, that's a lot. So in essence, we're kind of already doing a capital call preemptively just to be able to have a big buffer. So this property is gonna be sitting on $9 million in cash when it's closed. And all of Disrupt's holdings at the moment, every single property has at least $1 million in it, right? For that very reason. Because we don't want to come back to the investors and say, hey, we have a capital call situation and we're going to need you guys to reinvest. Because number one, mathematically, it just sounds like, hey, if your deal is not cash flowing positively, why would I put more money into it if you're just going to run out of more money over time? So that's one major concern there. And then two, um, if we're just never, it's better to not have that problem in the first place. So that's why with our assumed debt, we're already cash flowing from day one, right? And it's already occupied at a very high level at relatively low rental amounts. So once we start executing the business plan, like worst case scenario, let's just say we do nothing and we just write it out as it is, right? That will keep the property afloat, right? Without having to expend any of the capital expenditure dollars, right? Because we have a few lender required um, upgrades that have to be done. So some of those improvements have to be done by the lender's requirements. But all the other things that that are optional to us that we want to be able to do, we don't have to do those if things are really tough in the market. So we can save those dollars for a later time down the road, and that acts as additional reserves just in case. Does that make sense?
Yes, sir. Yeah, no, thank you. That makes a lot of sense.
Awesome. And then Mark had asked how much the acquisition fee and who gets it. The acquisition fee is 2% of the purchase price, which is $2.22 million. And that is going to go to all of the general partners. So, including myself, I get a little bit of split of that based on my contribution to the deal. The operators as a whole, Disrupt Equity, Open Door Capital, those sponsorship entities in the beginning of the presentation, everybody gets a prorated share depending on what their role in the deal is. And so for, I don't know, about 40 different individuals, that is run that way. And that fee, so you guys know, when you do an acquisition fee, is going to go towards the operating of these businesses that run these deals, right? Because if you think about how the cash flow for these properties go, 10% goes to Class A, and then 8% goes to Class B, and then there's a 70-30 split. By the time that cake goes into Class B, it turns into a cookie, and by the time the 70-30 split happens, it turns into crumbs, right? So between those crumbs that we get on the 30% on the back end, plus the asset management fee that's ongoing, that's going to be able to help keep the lights on while we're doing the work on this deal, the acquisition fee kind of funds us until we get the next acquisition done. That was a good question. Thomas, you're very welcome. Neat presentation. I thought it was neat. I like it. Come on, someone give me a hard question.
How often do you get deals like this where they bundle the 2 or 3 assets at a time? Is this something that happens rarely, or does this happen frequently?
Historically, for me, this is relatively rare. We've had 3 separate deals we found and operated and got under contract around the same time, that we bundled as a portfolio to our investors on our own, that we were going to, hey, we're going to take a portfolio loan, we're going to buy this and that property and put it together. We've done that last year with one of the Austin properties, the Cascade. That was part of the Sunbelt portfolio. We had that one, 189, 182 in Georgia, and then 128 in Daytona Beach. That was our Sunbelt portfolio. Oh, and we did it twice last year. We also had 2 properties in Texas. It was 241 in Dallas and 387 in Houston, Texas, Rayford's Edge. So that was a 2-pack portfolio. This is the first time when a seller had a portfolio and then they sold it to us and we assumed it as a portfolio as well. So for me, this is going to be my 20, 21, and 22nd acquisition, multifamily acquisition. And this is the first time that I've purchased a portfolio in place. So not to say that it doesn't happen often. There's some people that only buy portfolios because they want, mitigated risks. And a lot of times you'll see funds get together and they do stuff like that because they're probably deploying $50, $100 million at a time. So in order to be able to fill something, they would need to buy something like this regularly to be able to satisfy that need of capital.
And did the broker present it as a bundle deal, or was this part of something you guys could sort of customized? Like, we'll take the third one too.
No, this was presented from the broker. Broker was Newmark, ARA Newmark in Texas, and yeah, it was a fantastic opportunity. The seller wanted to sell it last year, but again, everybody was just real scared of buying with the rising interest rates. They're like, oh, there's no end in sight, and there was no way to be able to reliably get good debt. That you couldn't get good debt on this thing and realistically make it through the back end, because on the when you buy deals like this and there's a value add proposition, historically before last year, or right around the beginning of last year towards the middle of last year, that's the last time that you saw people using bridge debt. So they were using variable rate interest debt because that rate, the rates were low, right? And that was the way to be able to go ahead and you can get into that bridge debt. It's temporary debt. There's no prepayment penalties if you sell off that debt. So you get in there, do your value add proposition. It takes about 2.5, 3 years, and then you sell in that short time frame. You're like, boom, long-term fix and flip on like a couple hundred units. So that's how you make millions and millions and millions of dollars in multifamily. Now, what happened was people who were using bridge debt, like everybody was, then interest rates started going back up, right? So once interest rates started going back up, then all these deals started not penciling in anymore. And that's why everybody was like, okay, stop the buying. We're going to slow down. And so if you didn't pivot the way that we did, we started buying with fixed rate debt towards the end of the year and really low leverage. We're putting down 40, I think on one of my properties, we put down 47% as a down payment. Right? And we
to
had
offset that interest.
Yeah. Offset it was a higher interest rate because the cap rates were comparable to the interest rate. So it's kind of like breaking even, but in the long haul, worst case scenario, we hold that property for 10 years. That valuation and the cash flow and the inflation, we're gonna be cash flow positive, and the valuation is gonna be through the roof because inflation is just gonna keep driving the cost of the value of the dollar down, which means the valuation of the property is gonna be going up. It's gonna be worth more dollars in the future. And that's economically how we're going to be able to just, capitalize on this particular environment. And again, these are purchases that are done in some of the fastest growing MSAs, metropolitan statistical areas in the country, right? Because if I was buying this in, I don't know, Sumter, South Carolina, right? That ain't a city with high population growth or high job growth. So I wouldn't really expect over a long term. Over time, I'm pretty sure last time I looked at it, the population was decreasing. That's a dying town, so it needs some level, like some state or federal level infusion of capital. It's like some investor needs to come in and build like the coolest thing Sumter's ever seen and start driving people to have a reason to be there, right? Take it easy, Victor, man. Thanks for coming on. And Tony had asked about the 2-tier structure and Harnish. If you want to contact me, man, in the Facebook group, just shoot me a message, DM me, or you can actually shoot me a text message. There's only a few people here now, so I don't want to send this out. There you go. And that's not going to be on the recording, so people won't see the chat. So go ahead and save my number. You shoot me a text if you have any questions, anything like that. The 2-tiered structure that Tony was asking about. So this is the waterfall structure of how the cash moves in a multifamily deal. We collect all the rents and the other income, so we have this much money, and then we do our expenses to pay for property management, pay for insurance, taxes, repairs, turnover, marketing, legal, everything, right? Utilities. Then we have our NOI. Out of that NOI, you got to pay your debt service. Your debt service, hopefully your debt service coverage ratio is like at least 1.4, right? So it means you can pay your note plus 40% of your mortgage, right? That's what a 1.4 DSCR means. So with that 40% of the mortgage price left over, That's your distributable cash. Excuse me. That is where you're going to be able to do all your distributions. So the Class A from that distributable cash, they're going to get their 10% on their money first. And then after that, they're done. Class B now gets their 8% of the distributable, not of the distributable cash, of their investable amount, right? So if we've got $25 million in Class B shares, then we're going to pay 8% times $25 million, whatever that cash flow comes out to, right? $2 million bucks. Is that right? And then of that 2 million bucks, after that 2 million bucks is paid to the Class B shareholders, then the remaining amount, let's just say there's only $1 million left after that, right? Then there's a 70-30 split. So that 1 million is going to get $700,000 is going to go to the Class B shareholders, and then the general partners, the GPs, my squad, we're gonna split that $300,000. So that's typically how that happens. Now, if the property performs very well and you're calculated to get over a 15% internal rate of return, like year over year, you're making 15% of your money or more, then the amount of money that's split after that is no longer going to be 70-30, it's going to be 50-50. So until you guys make 15% of your money, then afterwards, then we go 50% to you, 50% to us. So that $1 million in that scenario would now be 500 to the LPs and 500 to the GPs. Does that clear it up for you, Tony? Awesome. I love it. Knowledge is expanding. Market asks, do you ever have to dip into reserves to pay the A and B holders? Is that monthly cash flow enough to cover the investors? That depends on the deal, and typically what would happen is until you complete your value add proposition, you may not necessarily have enough cash flow. And so normally Class A shareholders are paid first, and then whatever's remaining goes to pay the portion of the 8% that we can pay for the Class B shareholders. So that's why they're incentivized with the upside. They take the risk on the back end, right? Because like I said before, even if you have an 8% preferred return and we have $100,000 to pay you, or we have $100,000 to pay out to the investors, right? But let's just say we only have $50,000. So we're going to pay $50,000 to cover what we can. We get nothing. And then the other $50,000 that we owe, right? See you, Donna. Thank you. The other $50,000 that we owe you is going to go to our delinquent account amount. So we know that next year we were supposed to pay you your $100,000 plus the 50 that we didn't pay you that first year. And then that continues to accrue. But again, this is a value add play, right? So once we get to the point where we either refinance or we sell the property, we square up that account. Any IOUs that we have to the investors, they're going to get paid their preferred return first of the proceeds of the sale or refi before the general partners can even touch it. So until you make your money where you're supposed to be, then we don't get paid anything. That's why the 10% gets paid first, and then the 8% gets paid next, and then whatever's remaining after that gets split 70-30. Did that answer your question, Mark? Boom. Awesome, you guys. Hey, you're very welcome, man. So, yeah, man, these are some awesome questions. You guys need any other assistance in wanting to figure out how multifamily works? If you guys want, I also create guides to help everybody understand. You're very welcome, Tony. I'm glad you enjoyed it. If you guys need to figure out how this stuff works, you guys can reach out to me, shoot me a DM, or you can go directly to my investor portal at rasool.investnext.com, and you can learn about any opportunities I have there. Follow me on social media at Rasool CRE on IG or Rasool Mutawakil, just like my nameplate says here. So you can find me on Facebook, LinkedIn, all these other places. So Unless you guys have any other questions, man, I'm gonna go ahead and let y'all get some sleep or watch your show. All right. You're very welcome, Mark, man. Thanks for showing up, man. Have a good night, my friend. All right. It was great seeing you guys. Thanks you guys for spending the last hour and a half with me, man. It's really great. Very welcome, guys. All right. You guys have a good night. We'll talk soon. Bye-bye.